Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 9th of May, 2023. It's a Tuesday. And something big happened yesterday in the market. We're going to talk about that in today's show. But a little hint, we are now out of a bear market on the Nasdaq Composite. What that means to you going forward, I don't care what happens since December. What's this mean for the next 6, 12 months and beyond? We're going to break down what has gotten the Nasdaq out of this bear market into a new bull market and where you should be positioning yourself right now going forward. All that more coming up right now on Making Money. One of the most notorious months in investing calendar has arrived with a bang. You've likely heard the expression, sell in May and go away. And after all that's happened this week, you may be tempted to act on that. But I can almost guarantee you've never heard of this earth-shattering Wall Street event headed straight for US stocks in less than 60 days. Now, the date is all set. It's coming. 63 funds are actively preparing to send shockwaves for over $10 trillion of American wealth. And you have mere weeks to get ready before a wave of volatility crashes over half of the US stock market. My good friend and brilliant forensic accountant Joel Littman is stepping forward to help you protect yourself. If you have money in IRAs, 401ks, annuities, pension plans, stocks, or bonds, I urge you to give Joel's warning your most serious consideration. It couldn't be more important. Protect your wealth in the weeks ahead. Head to 2023selloff.com now to get his updates. Again, that's 2023selloff.com. Do not miss this. Again, this is Matt McCall. Thanks for joining me. It is May 9th. It's a Tuesday. It is, of course, 2023. As I mentioned, May 8th, Monday of this year, yesterday to be exact, the Nasdaq Composite, the basket of about 2,500 or so stocks in that Nasdaq index, the Composite Index, is now over 20% off the closing low of December 28th. And what that officially means by definition is that we are officially out of a bear market because we have now rallied 20+% from the closing low of the bear market that began about 18 months ago. The intraday low in the Nasdaq Composite was in October, but the market goes by the closing low. So I'll show you the chart here in a second. But again, since that time, up over 20%. Just give you an idea, the QQQs, that ETF that tracks the Nasdaq 100. So that's only 100 stocks there, not 2,500 plus. It's 100 stocks. That's the 100 largest by market cap, by size, in the Nasdaq Composite, non-financials, no financials in there. So just think Apple, Microsoft, Meta, Google, which is Alphabet, etc. Those are the big names in that. That came out of its bear market in March. And we'll talk about all that, breaking down large cap, small cap going forward. But before I jump any further, let's take a look at the Nasdaq Composite and where we stand today. So as you can see here, this is a Nasdaq Composite. Again, 2,500 stocks, give or take, in the composite. Different than a Nasdaq 100, which clearly is 100 stocks. You can see in the chart here, we closed up yesterday with a minimal gain here on the right-hand side. That second to the right bar, it's a green bar. And that took us off the December 28th low, closing low, I should say. If you take yourself back, look at the end of December, you see that big red bar, a Japanese candlestick, closing at the low of the day, and then rallying since then. We are down right now. We're taping this around 10:15 or so East Coast time in the morning. So we've only been open about 45 minutes. We're down about just under 0.4%. So we're hanging in right there. I'm going to say really one important thing about the chart here is that we did close at the best level since August. However, we can see in early February, the second trading day of February, we can see late March and really all throughout March, we've been consolidating in the Nasdaq Composite. So we haven't had a true breakout yet. But if we do break out, we're at 12,210. We probably run around 13,210, which gives us about 1,000 points on the upside, which is about what, 8.5%, 9%. That's a big move. And we already have the Nasdaq up with a big gain this year of double digits. That'd be a really big move. That'd take us to 20% plus on the Nasdaq year to date if we get up there. The other thing I'm going to mention, you can see from the low in January, the low in March, the low in April, you could connect and have what's called an uptrend line, lower left, upper right. And that flat line on top, folks, that's creating what's called an ascending triangle. So a break above this 12,250, let's call it, this index runs. And when I say it runs, folks, it will run. So please, we need to keep an eye on that index. What happened yesterday is a great headline, great enough that I'm talking about it. That being said, the true breakout to me has not been confirmed as of yet. I'll show you real quick the S&P 500. Here's the SPY tracking index. You can see it has not broken out yet above its February high. It's still near that April high as well. And it's up about 16% or so. You can see here 16% or so year to date. And until that really breaks out, it's tough to get extremely bullish in the near term, but we'll talk about that more in a second. And just give you an idea, since the lows for the S&P, it's up about 16% off the lows. The Dow Jones about 17%. So those two indexes have yet to break to a new bull market, still technically in that bear market. And, the NASDAQ did this not too long ago. It exited a bear market in August 2022, but within 2 months after that, we know where we were, October, back into a bear market and just got out of it as of late. So 7 months, though, from that intraday low in October, that's how long it's taken us. And the fact that it's actually taking that amount of time to me is actually not a bad thing, because it shows that it's not just as what they call a V-shape, a snapback. We've actually taken our time to get back. And that's actually a good thing. We'll talk about that here in a little bit. So what were some of the biggest winners? So I went back and I looked from that December 28th low in a Nasdaq Composite and look to see what some of the biggest winners of that composite. And when there's 2,500 stocks, you're going to have some small companies in there. Some of the biggest winners were penny stocks that really, I don't even want to mention them. Some of them were crypto related, because remember, Bitcoin back then was really low and it's come up a lot. So a lot of the miners and the smaller players that are related to cryptocurrencies have had big moves off the lows of December as well. Then I looked some of the top returners, and I based those off anything that right now has a market valuation of at least $1 billion. I didn't want to bring anything too small into this. And what I noticed, the top two gainers that were in that area were biotech related. And that's never a big surprise either, folks, because biotech stocks, when they move, they tend to move. And they usually move on one of two things: either some type of approval by the FDA for one of their treatments, or by a takeover, or by a large pharmaceutical company investing in it, doing some type of collaboration. But the biggest winner was TG Therapeutics, as far as over $1 billion in Nasdaq Composite, symbol TGTX, which ended last year around $10 and change, and right now is at 32.5. Another one that was a big winner was IMGN, again, another biotech, Immunogen. Just recently ran from $4 and change up to 13 and change in a matter of 2 weeks. Of course, driven by big news out there. So those have been some of the biggest winners. But then I found two stocks, folks. Two stocks that are enormous tech companies that since that bottom are up over 100% heading into today. These numbers are as of Monday's close. Those two names are, I'll show them to you here. First one's NVIDIA. Been a big winner when it comes to artificial intelligence and chips. Their chips are used in electric vehicles, autonomous vehicles, obviously artificial intelligence, data, security, gaming, you name it, cryptocurrencies. This is a stock that to me is a bellwether. And I've said this many times on the show before. NVIDIA will be a $1 trillion company during the roaring 2020s. I'm very, very confident that will be the case for NVIDIA. And the other big winner here has been Meta, which is formerly known as Facebook, symbol META, up about 101% since that low. And I mentioned before, NVIDIA was up 107%. Both stocks down a little bit today, but again, we're about an hour in trading, folks. But look at this chart here on Meta. It really bottomed in November in the high 80s, and now we're at $232 a share. I mean, what a hell of a comeback. But that being said, we're still well off the 385, give or take, where we hit an all-time high back in 2021. But a couple gaps to the upside. You can see one in February, one about 2.5 weeks ago. This is still a very nice move. And for full disclosure, I own some shares of Meta, not a lot, in my personal account. And not saying buy or sell. Nothing is a buy or sell recommendation, just sharing the stats with you, but up 101% since that low on December 28th for the Nasdaq Composite at that time. So what sectors have been leading this? Well, within the Nasdaq Composite, the semiconductor ETF, SMH, is up about 27%. XLK, which is a big tech ETF, it's got, again, Microsoft, Apple, Google, Meta, etc., up about 24%. Gold miners, believe it or not, the GDX up 23% in that same time frame. Very, very interesting. You could have bought into gold miners and into tech and done very, very well. You think you're diversifying, but they both went up. We also had consumer discretionary at 17%. Again, that tends to do well in the market as well because people tend to be a little more easy with their money and spending more money. Also, the number one performer, which I skipped over to get to the tech, was ITB, which we talked about just recently. That's the home builders. The home builder stocks continue to do well. I mean, you can read the headlines about how bad the housing market is, but look at this chart, folks. This is today. If ITB closes up where it is right now, it's up 0.6%. It would be the best close in ITB since the middle of January of 2022. Not this January 2022. 16-month high. 15-month high almost, actually. Unbelievable. You would not know that reading the headlines. So that's been the biggest winner since December 28th as far as sector ETFs. Of course, the losers, regional bank ETF, KRE, down 35% in that time frame. We know why. XLE Energy, oil's really pulled back down 7%. XLF, which is a large financials, holding up much better than regionals, but still down 4%, underperforming the market. And utilities, which is tracked by XLU, down 2% in that time frame. And of course, I love to invest internationally. And I was looking at some countries, and this country I talked about a couple months ago, and I still think it's a great investment long-term. And that's Mexico. The iShares Mexican ETF, EWW is a symbol, up 21% in that time frame. So I think there's a lot of still upside potential there. Now I want to take a look here at going forward, because there's one thing to take a look back and learn from it, which I love doing. When you look back in history, you don't assume history repeats itself, but you educate yourself based on what the market's done. And the reason for that is the market's driven by one thing and one thing only: human psychology. Sure, human psychology is driven by a million different factors. But at the end of the day, I mean, sure, there's algorithms out there, but somebody still writes that algorithm. It's driven by human emotion for the most part. And that hasn't changed in 100 plus years. So you can still look back on how markets react and assume the human reaction will be very similar, if not the same. So we don't look back, but we want to look forward now, because we can't invest looking in the rearview mirror. We have to look forward. I have a bullish thesis for you and a bearish thesis. I'm going to play both sides of the aisle. I'm going to be like a very true politician, just completely looking at one side when they talk to one group and another side when they talk to another group. I'm going to let you decide whether it's a bullish thesis or bearish thesis that you believe in. Number one, for the bullish thesis, folks, the intraday bear market low, the intraday, not the closing low of December 28th for the Nasdaq Composite, but the intraday low was in October. That's more than 6 months from now. That was more than 6 months ago. If we look back, this is from Bespoke, since World War II, when a market is 6 months post a major bear market, which we were in and we're post that it is up 12 of the 13 times in the next 6 and 12 months. So that bodes well. The one time it didn't happen was in 2000, 2001 during the tech bubble that we went through at that time. So that's number one we're going to take a look at. Another thing I want to take a look at is investors' sentiment. And if we look at investor sentiment, we can see that the AAII, which is American Association of Individual Investors, comes out every week, bull, bear, neutral. They had 44 consecutive weeks of more bears than bulls that ended earlier this year, but we're already back on a new streak of at least 10. And when we look at those streaks, historically, if they're taking a contrarian view, there's that many individual investors that are that bearish, you want to look the other way. And typically the market does very good after very bearish times in the stock market, in consumer sentiment and investor sentiment. Another reason I would lean to the bullish side is that I believe inflation has peaked. And I think that's an obvious statement. It peaked last year. But not only has it peaked, but I believe it will continue to drop. And as it continues to drop, the Fed will then be able to sit on their hands. And that leads me to the fourth factor, that the Fed is going to pause raising interest rates. I don't know if they cut by the end of the year. I think it's still about a 50-50, a coin toss if they cut interest rates by the end of the year. I kind of hope they don't. And the reason for that is if they pause, the economy doesn't go into a deep recession. I don't care if we go into a shallow recession. That's priced in. I could care less about that. If we go into a shallow recession, that doesn't concern me at all. If we go into a much deeper and more difficult recession than the market's priced in, then the Fed will be forced to cut interest rates. So if, in my perfect mind here, the Fed does not raise rates anymore, we go into a mild recession. We're already in an earnings recession. I talked about that last week. You go into a mild recession, I think the market actually holds up really well. And then typically when the Fed pauses, the market's very strong the next 12 months after that. So if it does decide that the last raise was a week ago, and we could be setting up for a nice run to the end of the year into next year. And then don't forget, we have the election coming up next year. And typically the incumbents like to do a lot of nice things to keep the market propped up, keep the economy propped up to look good and get reelected. Who knows if that will happen, but it tends to happen historically. And then the fifth one I want to take a look at here is I'm going to look at the 60-40 portfolio. And I got a chart over here for you, folks. This is where you're 60% into stocks, 40% into bonds. And we all know that this portfolio got absolutely demolished last year. One of the worst years in the last 100 years for the 60-40 portfolio because bonds were so bad. At one point, the 60-40 portfolio had a drawdown from its high of 20% last year, I believe in end of September. But here's a chart of the 60-40 portfolio. And if you go back to 08, 09, when the bull market started after the great financial crisis, you can see here, if you draw an uptrend line, even with that pullback on the right-hand side, which was a massive pullback on any scale, we're still above the uptrend line because look how far ahead of that uptrend line this market got. Why? Because interest rates were driven down to basically zero. And when rates go down, bond prices go up and stocks are going at the same time. So it was a perfect storm for the bulls. We then pulled back to reality, but we didn't break that long-term uptrend. To me, folks, that is bullish. That is actually a really good sign that we didn't break. We're kind of just back into that normal time, which is not, again, necessarily a bad thing. All right, so let's flip over now to the other side of the aisle and the bearish argument. The bearish argument is obviously, number one would be a banking crisis, right? I mean, we're looking at right now 3 major bank failures. The most recent First Republic was the second largest bank failure ever after Wells Fargo during the great financial crisis. You throw in Silicon Valley, you throw in Signature Bank, it's 3 of the largest bank failures ever. And is that over? I don't know. I honestly couldn't tell you. And if we look at the chart here of this is KRE, this is the Spider S&P Regional Bank ETF, down under 1.7% today. This would be the second worst close we've had in a couple of years. This tells me that we're probably not done with it. All that being said, you saw how ugly that chart was. The same time that the regional banks are getting smoked, with the Nasdaq Composite going to a new bull market yesterday. So it's really weird times, to say the least, but there could be more fallout from the banking crisis. We'll probably know a little bit more in the next 2 months, I'd say. between 1 day and 2 months from now, we should know a lot more. But I got to tell you, I don't know. I think there could be a little bit more to come out of this. I don't think we're done. Then we have what's called the inverted yield curve. You can look at it a lot of different ways. The one the Fed likes to look at is a 3-month over 10-year. And the way that this works is typically if you buy a 10-year treasury, you should get a higher interest rate than you would get from a 3-month because you're locking in for a longer time. When that inverts and the 3 months paying more, it's called inverted. We're inverted to the tune, this was a couple of days ago, of 167 basis points, 167, a negative 167. You can see in the chart here. It's the lowest level, the biggest inversion, I guess you could say, going back to, yes, this is the late 70s, early 80s. I mean, I was just a toddler going back that far. And typically when that happens, folks, it's not that great for the economy. Because we go back to the 60s, anytime there's been an inversion this big, every single time it's led to a recession. But as I mentioned earlier, we could have a shallow recession. And again, I think that's priced in. But a deep recession is not priced in the market. And that could cause trouble. So again, that's number two on the bearish thesis. Number 3, and this is something that I'm throwing out there because it's a headline right now. I think it's going to be fine because it's always fine, is the debt ceiling. It's political bullshit posturing from both sides of the aisle. I mean, it just depends who's in power. That in power always says the other party won't they don't want us to raise it. The party in power has to raise it because they don't want to be the party in power that defaults here in America on paying your bills, paying the debt, paying everything in the budget. The party in power, the Democrats don't want that. So they're going to blame the Republicans and vice versa when the Republicans are in power. But some of the stuff that's coming across is such BS. And they'll get it done at the last minute, or they may push it a day or two past, but they'll get it done. But at the meantime, it's going to be one hell of a headline because both sides of the media, left and right, love to bash the other side, and it's a great, easy, juicy topic to do it. So bearish in the short term. Then there's seasonality, sell in May and go away. This worked really well decades ago, but the fact that it's one of the most well-known adages in Wall Street, stuff's not that easy. So there's still numbers that show it, yes, but I could show you many other numbers. We're not going to get too deep into it that prove historically, the last 20 years or so, it just doesn't work as well. It just doesn't. So selling May and going away, I wish it was that easy to sell for 6 months, come back on for 6 months, take a vacation for 6 months, and not that easy. So that's the bearish argument if we want to play both sides. And I want to be fair and present both sides. And of course, the bears out there right now are yelling at the computer saying, here's so many more things you could be bearish about. And there are. But a lot of them are just so out there. The likelihood of them happening are so small. And that doesn't work when you invest. So I'm going to end on a bullish note. And but before we get there, I'm going to show you one other thing from this year. And this can be considered bullish or bearish, either way. This is as of May 8th, which is yesterday. And this shows the year-to-date stock performance by index. And it goes from left to right. Little do you know that on the left are the largest, and then on the right are the smallest of these indices. When I say smallest, the companies that make them up are the largest and smallest. The Nasdaq 100 I talked about, up 11.5%. That's the 100 largest Nasdaq non-financials. Big tech, let's call it. The S&P 100. That's the 100 largest companies in the S&P 500. Get rid of the 400 more. So not as tech heavy, up about 5% year to date. Look at the entire S&P 500 by itself, about 2.6% year to date. Look at it in S&P 400 mid cap. Those are going to be the next 400 that aren't quite in the S&P 500 yet. 2.1%. Look at this small cap, the next 600 below that. Down 1.9%. And Russell is a micro cap. Those are typically 2 billion and less, down just a fraction. But you can see that the small guys are getting crushed compared to the big tech. And there's a lot of reasons, and I'm not going to delve too much into this. Again, you can view this as a bearish and saying the only reason the market's up is because of a few big stocks. Yeah, I can agree with that argument as well. You can look at it in a bullish way and saying, hey, these small caps have now lagged for a couple of years. Historically, they don't lag this long. When they turn around, this market's going to be driven, and it's going to be more of a breadth driven, meaning a larger portion of the market will drive the next rally, and it won't be in big tech. And I got to tell you, I see a lot more opportunities in small mid caps than I do in large tech. Is it ready to turn around today? Probably not, but soon. The moment the Fed does pause, you look for these small caps, folks, they're going to turn around. And they're going to turn around in a big, big way. All right, so the last thing I'm going to show you here is some bullish stuff here. Two charts, one infographic and one chart. Let me start with the kind of chart here first. These are the max drawdowns and the total returns going back to 1928, so 95 years. And you can see the TR is a total return for the years for the S&P 500. And you can see, especially in the last 2.5, 3 decades or so, actually probably 5 decades or so, since 68, a lot more green than red. And about 73% of the time over the last 100 years, the market's up on an annual basis. That's a hell of a return. But you look at the drawdowns, that's a DD. Big drawdowns, but the market tends to turn around quite a bit. And that's important, folks. That's important to know because the markets will go down, but you must be ready for them to turn up. Now, here's one more really cool infographic we pulled from you here. This is by a company that Markets to a Minute, it's called. You can see this is the best, worst, and average investment returns over the last 94 years. And you can see here that since 1926, that the bonds, they have posted a negative return only 15% of the time. The 60-40 portfolio, 23% of the time, and stocks 28. So 72% of the time, you're still up with 100% in stocks. And most of you out there have some bond exposure. Say it's a 60-40, you have a 77% chance of going up. And then we look over here on the right-hand side. This starts at 100% bonds up top and goes 90, 80, all the way down to 0. The average return when 100% stocks is 10.3% a year. That means you double your money every about 6.8 or so years, a little less than 7 years. That's really impressive. Where else in the world are you going to do that? The best return, 54.2%, worst, 43.1%. So you have to deal with some bad returns along the way. But again, over time, over history, and even if you did the 60-40, the average return is 8.8%. That's pretty darn impressive. The worst return was 26.6%. That was in 1931. So you're looking back 92 years in the past. So we'll end on a positive note is if you're a long-term investor, the U.S. stock market is one of the greatest, I will say it is the greatest wealth creator for the average American over the last century. And I don't think that's going to change in the next century. So stick with it, invest in solid, long-term, good companies. I'll tell you, you'll come out very happy on the other side. You work pretty damn hard for your money. Let that money work for you in the U.S. stock market. All right, folks, thank you very much for watching and listening today. Don't forget to subscribe, like, share it with your friends. And again, you can always sign up for our daily email that goes out for free every single day the stock market is open. Have a great Tuesday. Thanks so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.